on board Amarendu Prakash, who is the Chairman and Managing Director of Steel Authority of India, joining us. A very good morning and thank you so much for your time. And firstly, on to your numbers. The Q1 FY26 numbers have been a little weak than what rather the street was penciling in. There was a miss on the EBITDA as well. If you can help us understand that what were the factors that were at play, and were they lower than your internal estimate too, and what really led to that weakness?
If we look at CPLY numbers, you see a growth. Quarter-over-quarter numbers are expected to be lower for the steel industry in general, because as you see, fourth quarter is always the production quarter, whereas first and second quarter is the time when steel industry plans its maintenance activities of the plants. However, compared to CPLY, you see there is a volume growth in sales as well as in production numbers of saleable steel. Almost 12 to 13% saleable steel numbers are higher. Accordingly, the revenue is also higher. The one number that is to be factored in is the stock valuation impact. As compared to CPLY, we have had a stock valuation negative impact of 1,080 crores. So that's the difference that we find in the final PBT and PAT numbers, which is an accounting entry valid only for this quarter. So it does not bother us. Structurally, it also shows that the costs of our material have come down. And because of that lower cost, inventory has got valued at those numbers, so the stock valuation impact. So we feel fundamentally that company operationally is better than last year, and also sales-wise and market stability-wise, we are quite positive.
Right. Mr. Prakash, since you just spoke about the impact of stock valuation on earnings this time, you're telling us that it is largely a one-time adjustment and it is unlikely to recur in the coming quarters, right?
You're right. It is not likely to come again. Rather, it can improve if the market goes up.
All right, along with that, your EBITDA per ton for the quarter one, that really stood at 6,085 rupees per ton. That's a jump of 10% on a YOY basis. But do you expect the coking coal prices to remain steady over the next few months? And consequently, how are the spreads expected to shape up in the coming quarters?
Coking coal, there is no reason for coking coal to move much. If we look at last 6 months, last 2 quarters, the prices have been stable, and we see no reason for prices to change by much. It will remain range bound in our expectations. As far as the margins go, as I mentioned, the cost efficiencies that we have been working on is paying off, as you saw in YOY figures. And going forward, there will be further cost reduction in our operations. And so the spread should enhance.
Well, another question is on the margins trajectory. Will we see margin expansion? And if so, how much? Can you quantify it for us? How much margin expansion could we see in the second quarter?
Say an improvement of about 5% going forward should be expected.
All right. So in your call, after your earnings, your guided total Capex was 7,500 crore for FY26, and also briefly mentioned that Capex for FY27 is expected to be higher than FY26. Can you quantify this for us? Will 8,500 to 9,000 crore Capex be a fair estimate to work with for FY27, or it will be a slight higher number?
If you look at FY26 Capex numbers, basically Capex is one on debottlenecking the old capacities that we have. And also we have an expansion plan of going from 20 million ton capacity to 35 million ton capacity. So current year FY26 Capex is primarily towards debottlenecking and maintenance activities. In FY27, our expansion program will start hitting the ground, and so the Capex numbers depends on the accruals, internal accruals. We are positive on the internal accruals, but still the Capex numbers can go up to 10,000 crores too.
All right, just to follow up there, so with respect to the Capex, so 10,000 crores for FY27, will that be a fair estimate? And what about the next 4 to 5 years? What kind of a Capex that you are planning to do in the next 4 to 5 years, and consequently to your Capex plan, what will be the impact on debt?
Overall Capex program is upwards of 1 lakh crore over 5 years. 5 to 6 years. Quite a lot of it, we are hoping that we should be able to meet through internal accruals. If you look at the borrowing numbers, last year we reduced our borrowings. This year, first quarter also, we have reduced our borrowings by 1,100 crores. So by the end of this year, we would have brought down our borrowings from the year beginning level by say 4 to 5,000 crores further. So the Capex numbers will increase, probably hitting a number 3 years down the line, 15,000 crore annual number will be there. And then it will start tapering off as these capacities start paying back.
All right, Mr. Prakash, thank you for giving your views and talking to us on the quarterly numbers, and wish you good luck for the coming quarters.